Welcome to Clark Schaefer Hackett's 2022 podcast, Fiscal Footnotes, where we strive to provide useful insights and practical knowledge around current tax, audit, HR, and other business performance topics that impact your organization and its ongoing success. My name is Patrick Hinker, and I will be your host today. A little bit about my background. I am a director within Clark Schaefer Hackett's Managed Services Group, and I have over 20 years of experience in both public and private accounting across several different industries. Today's important topic is focused on the new Lease Accounting Standard, ASC 842, and includes a two-part series called Countdown to ASC 842 Readiness. This series will address key areas pertaining to compliance and implementation of the new Lease Accounting Standard. The two sections in this series include Part 1, History, Goals, and Key Impacts of ASC 842, and Part 2, Steps, Tools, and Common Stumbling Blocks for ASC 842 implementation. Today, we will be talking to two of our firm's lease accounting subject matter experts who consistently consult with businesses who need support related to lease accounting compliance and implementation. Our subject matter experts are Katie Schneeber and Michael Cullum. Katie, let's start with you. Tell us a little bit about yourself, your background, and your experience with the new Lease Accounting Standard.
Sure. Thanks, Patrick. My name is Katie Schneeber, and I work in the assurance department and lead teams for completing audits, reviews, and compilations for our clients. I specialize in the financial and professional services industries, as well as manufacturers and distributors. And over the past few years, I've had the distinct pleasure to work with Patrick and Michael on learning everything we can about leases, and I'm very excited to share some of that information with you today.
Thanks, Katie. Looking forward to talking with you more about it. Michael, let's turn to you.
Yeah, thanks, Patrick. So my name is Michael Cullum. I've been with the firm for about 11 years. I'm a senior manager in our assurance department. So that means I work on things from audits to reviews to compilations to agreed upon procedures to just about anything else. My main focus is construction and real estate companies, as well as commercial services organizations, not-for-profits, manufacturers and distributors, and kind of all over the place. And I, like Katie, was somehow tapped to be our firm expert about 6 years ago when all this came down from FASB. So I feel really honored as well, Katie. I feel like we're the chosen few that we get to really know this topic inside and out, huh? I mean, I guess
That's
you're
right.
probably teaching this to your students too, aren't you?
I am. Yes, it has come up once or twice.
Thank you both. So let's dive in with the first question. Katie and Michael, ASC 842 became effective on January 1st, 2022, and now companies have just a few short months left to prepare for how they will classify and account for leases related to their businesses. Can you tell us more about when and why ASC 842 was implemented?
Sure. So the new lease standard became effective, as Patrick mentioned, on January 1st of 22 for privately held companies that have year ends of a calendar year of 12/31. The public companies actually already had to adopt this back in 2019. So we can use them as the guinea pigs for some of our disclosure examples. But as Patrick was saying, we only have a few short months to get this implemented. And a little bit of background on why the FASB wanted to do this, the Financial Accounting Standards Board wanted to do this, was to create more transparency about financial commitments that various companies have. Also, you could think about these as off-balance sheet items. So we currently don't see them if you're looking at a standard balance sheet. And so they want to see what those actual liabilities are for commitments. And this also came about from the idea that the FASB wanted to align more with what the IFRS was doing across the world. And so we're moving more towards a principles-based accounting. And so the standard provides some additional and enhanced disclosures to be more in line with those.
Thanks, Katie. Let's keep moving. Michael, give us a brief rundown on how leases are currently accounted for under the existing codification, ASC 840.
Yeah, I'd be happy to. So like you mentioned, the old guidance is ASC 840 and the new guidance is ASC 842. So you'll hear us refer to those back and forth as we talk today. But really under the old guidance, there's two types of leases. There's operating leases and capital leases. And hopefully everybody knows what those are. We've had that guidance for a really long time, and they've been taught to us, 104, 202, whatever they are, So hopefully everybody knows those, but really there's a main difference between operating and capital leases is the bright line test that we have under 840. And there's four things. So number one is, does ownership transfer at the end of the lease? And if that's the case, then that's a dead giveaway that we've got a capital lease. Number two is if there's a bargain purchase option at the end of the lease. Again, that's a dead giveaway that if you can buy the bulldozer that you're leasing for $1 at the end of the lease, we've basically got a transfer of ownership there. So we would call that a capital lease. And then the last two are a little bit more difficult, and they are things like number one, if the lease life is 75% or more of the useful life of the fixed asset or property, or if the present value of all the lease payments adds up to 90% or more of the fair market value of the asset. So I realize that sounds like a whole bunch of gobbledygook, but the point is, if you're leasing this item for a huge chunk of its useful life, or if you're leasing it for a dollar amount that would basically equate to buying it, the fair market value of buying it, then those are two dead giveaways that we've got capital leases. And again, this is the old guidance. So things are a little bit different under the new guidance, which I think we'll talk about in a little bit. But the other thing to mention is, under the old guidance, capital leases have a balance sheet impact. We carry debt for the capital lease, and then we'll also carry the fixed asset on our books. Under the old guidance for an operating lease, there is no balance sheet impact. We will see cash leave when you make the payments, but other than that, there's nothing on the balance sheet for those operating leases. Completely off balance sheet. And then the last difference is the disclosures for operating leases occur only in the footnotes, and they're not very in depth. It'll be things like a 5-year maturity schedule and what the total lease expense is for the period. But capital leases, on the other hand, are very in depth, and they have a lot of information that go into those. So that's some of the big differences between capital leases and operating leases, and that's the old guidance.
Katie, he talked about the old guidance. Let's highlight some of the new changes and features that we'll see with ASC 842.
Sure. So the good news is there are still going to only be 2 different types of leases. So we don't have to add in any more than that. But for the finance leases and those bright line tests that Michael was describing, the bright line piece is going to go away. But the treatment of capital leases is going to be the same. The only reason that there's a change there is that those are going to be referred to as finance leases going forward. And for the operating leases, the biggest change is that the activity and remaining balances of our leases are going to go on the balance sheet. So there's going to be a new asset called a right of use asset. And then there's going to be a new liability on the balance sheet called a lease liability. And for those of you that present a classified balance sheet, that will be broken out into a current portion and a long-term portion, just like debt is presented today. And then, as Michael was mentioning, there are some expanded disclosures, which we will get to in a little bit.
Katie, a follow-up question for you on right-of-use assets. Is that considered a fixed asset or an intangible asset?
So it's going to be treated very similar to a fixed asset, but technically it's going to go down in that other asset section, and it will be treated more like an intangible, but it will be amortized over the useful life of that asset.
Got it. Thanks. Michael, you talked about some changes in the disclosures in the financial statement footnotes. Why don't you elaborate a little bit more of those?
Yeah, I feel like I get to be the bad guy. So they really fall into 2 buckets. We're going to have qualitative disclosures and quantitative disclosures. And I think most important and a stumbling block that I can foresee with several clients is we're going to have to separate all of these qualitative and quantitative disclosures, one section being operating leases and one section being finance leases. So we can't intermingle these 2 disclosures and just kind of lump them all together. So we will have to separate those out, which might be a pain, or it might just take up a lot of paper. So we'll see. But like I mentioned, 2 buckets. So the qualitative disclosures are things like the nature of leases, terms and conditions, lease payments that are due, if there's options to extend, if you have leases that you've signed for a future period that haven't commenced yet. That's something that we would disclose in a narrative form. and then any significant assumptions that management's using in these lease calculations. And then the other bucket is the quantitative, and this is where I think people are going to stumble a little bit. This is a little bit more difficult. So it's the typical things like a total lease cost for the year, if there's any variable lease expense and the impact that has, sublease income if that applies, total cash paid for leases during the year. And then where it gets a little bit more complicated is some of the new disclosures are things like the weighted average remaining lease term that's outstanding and the weighted average discount rate being used. So, depending if you've got 2 leases, maybe that's not real difficult to calculate. If you've got 60 leases, calculating that weighted average is probably going to be a little bit more difficult. And the way that I like to think about it is for anybody who's got disclosures for stock options in their footnotes, in a lot of ways, these lease footnotes are going to start to look a lot like stock option disclosures.
Michael, that sounds like a significant change versus what we've seen over the last few years, specifically on operating leases. Thanks. Let's do a toss-up question here. And before we go any further with our discussion around ASC 842, can you review the definition of a lease? And as we go into that, what types of contracts or agreements might we find leases?
So ASC 842 gives a newly redefined definition for what a lease is. And it says that it is a contract that conveys the control and use of an identified property, plant, or equipment, or just an asset for a specified period of time in exchange for consideration. So a typical monthly lease payment. Control is a very key element of this new definition. And companies should ask themselves, can we obtain all of the economic benefits from using this asset? And do we have the right to direct the use of the asset? So once that is defined, then you have a lease. Where this can get a little bit difficult is if companies have what the standard refers to as an embedded lease. This is where leases may be hidden in a separate contract, and the use of that asset or identification of the asset might be a little bit more difficult. But the FASB has also, and it's actually in the written standard itself, if anyone's interested in looking this up, there's a really neat flow chart that is presented. It's kind of like one of those choose your own adventure books that when you were a kid, you ask this question. If yes, go to the right. If no, go to the left. And so there's 5 questions that you can ask yourself when you're trying to decide if a contract does include a lease. So I'd highly suggest looking that up for all of our visual learners out there.
Yeah, absolutely. And we should mention 2 things that are specifically scoped out, and that's things like biological assets. So if you're, leasing an animal or something, like if you're a zoo or something and you're leasing an animal, that would be scoped out. Or if you're leasing timber rights, that would be scoped out. And then the other big one is intangibles. So software licenses, that's something that's going to come across for a lot of companies. That would be scoped out, as are things like trademarks. And then also if you're leasing inventory, that would be scoped out of this as well.
We're getting more into the meat of the story in ASC 842 and in our leases. I'd like to broadly review the definition and some of the terms that you've used earlier. Lease term versus lease commencement date. Michael, why is it important to understand the distinction?
Yeah, absolutely. So if you think about why lease term is important, historically, it's not been that big a deal, at least for operating leases, because it's not on the balance sheet. So, it's kind of, you pay as you go, and unless there's escalating rent, nothing's ever going to show up on your balance sheet unless, like I said, unless there's escalating rent, and then you might have deferred rent. But, now that's out the window. Under the new guidance, something's hitting the balance sheet no matter what. So lease term is important because the lease term is critical when we're calculating our lease liability. So the FASB made specific steps to kind of lay out what the lease term should be. So what that is that's the non-cancelable period, which the lessee obtains the right to use the asset. And if only it was so simple, but nothing ever is. So we'll have the original life that might be easy to see in the lease agreement, but then there's also things like lease extensions. If you have a 5-year lease and you have 3 options to renew for 5 years each, is it a 5-year lease, 10-year, 15, 20-year? A decision needs to be made before we book our lease liability, because that's going to have a big impact. And then there's things like, lease termination. If you have the right to terminate a lease at some point, that's something we need to think about when we're booking our lease liability and calculating that. And then the last thing that you see a little bit less frequently is sometimes the lessor has the right to extend a lease or to terminate a lease. So we need to think about the impact that might have on our lease liability and our lease term. And Patrick, you mentioned commencement date, and I think this is particularly interesting. And I feel like this could be a pretty easily stumbling block for somebody if they weren't thinking about it. So you might have a lease inception day, the day that you sign a lease. Like I might go lease an apartment downtown, and I might sign it today, but I might not move in for 6 months because the lease doesn't start for 6 months. They have to finish the building or whatever it might be. So the difference between the lease inception date and the lease commencement date can make a big difference. So what we'll use when we're calculating the lease term is the commencement date, which the commencement date is when the asset that you're leasing comes available for you to use. It's really the day that it makes sense for you to either start using the apartment or you to start using the bulldozer. Once that's available for you, that's the commencement date. So we would use that date to calculate our lease term start and go forward.
So commencement date is when we're putting it on the balance sheet. Is that correct?
Yes.
Thank you. So Katie and Michael, what we've really talked about to date is about the 3, the 5, the 7-year leases, some even longer. Katie, tell us a little bit about how short-term leases are handled within ASC 842.
Sure. So there is an option that you can elect when you are adopting a standard, and that is to not include short-term leases. Short-term leases would be defined as a lease with 12 months or less in the term, and that the purchase option, if there was one, is reasonably certain to not be exercised. So one question that I typically get on this is, oh, perfect, I can skirt the lease standard by just arranging all of my leases to be under 12 months long. Unfortunately, that is not true, because if there are those extensions like Michael was just referring to, those actually have to be built into the lease calculation. So unfortunately, this doesn't give us a free pass to not adopt the standard.
I envision that most lessors want longer term leases as well.
Yeah, yes. I think so.
What do we need to understand regarding contracts that do have embedded leases within them? What should we look for regarding lease components too?
Yeah, really the embedded lease question boils down to lease components. So in the same way that we would think about, we were mentioning topic 606 earlier, and in the same way we break apart how we would recognize revenue in contracts where there's several revenue sources. We do the same thing with the leases, and you can tell that this is all coming out of the FASB at the same time because, like Katie mentioned earlier, it's all principles based. So we'll separate these leases into their separate components, and when we think about the lease components, there's a couple guidelines for us to think through, and really it's, can the lessee benefit from the right to use on its own or not? Is for each component, can they benefit from each component separately, or do they all kind of work together to provide the one thing that the lessee is trying to obtain? I think maybe a better way of saying that is, are each of those components highly interrelated and dependent on each other? So maybe an example would be, if I'm going to rent office space on the 30th floor of a building, and the lease says, hey, you can use the elevator too. I think that those things are pretty highly interrelated. I'm probably not climbing 30 flights of stairs to get to my office every day. And I probably have no use of the...
I certainly wouldn't be.
And I have no use of using the elevator if I'm not going up to that office on the 30th floor. So those two things are highly related and dependent on each other. So in those cases, it might not be two separate lease components in that case, despite it maybe being broken out within the lease contract. Does that make sense, Patrick?
It does. It does. I think if you're going up 30 flights of stairs, make sure you pack a lunch too, because you're not going back down
Yeah.
at noon. Kate, you want to dive in on some of the lease component pieces, the three of them?
Sure. Yes, there are three technical different lease components. So a lease component itself is defined as the right to use the underlying asset. So that's primarily what we were just referring to with the office space. So the lease component would be the right to use that office space on the 30th floor of the building. A non-lease component is an activity that's going to transfer a good or service or value to the lessee. And so building off of the office space example, this would be a common area maintenance, such as the open areas that everybody walks through to get to the elevator bank to then go up to your floor. And then the last one is not a separate component, which is provisions that are related to administrative tasks to initiate a lease that do not transfer a good or service or value to the lessee, but are necessary in order to have the lease as a whole operate, such as paying the property taxes or insurance for the lessor. But as a practical expedient, lessees can elect not to separate lease and non-lease components. I would only suggest doing this if it's easier. Otherwise, you can just use that lease component, the primary item that's being leased.
Thanks, Katie. Let's keep moving. So when a business is looking at their lease portfolio, what are the criteria for distinguishing a financing lease from an operating lease under ASC 842?
Sure. So as Michael was saying back a few topics ago, the same primary questions exist for differentiating between a finance lease and an operating lease in the new guidance versus the old guidance. However, those bright line tests were removed. So the 90% was taken out, and it's now verbiage such as substantially all. And the 75% was taken out, and it's the majority of. So again, moving more towards those principle-based terminology into whether an item should be a finance lease or an operating lease. So the four criteria are going to be that they allow for a purchase of the asset. The lease term represents the majority of the remaining economic life. The present value of the lease payments exceeds substantially all of the fair value of the asset, and the asset doesn't have any other specified use at the end of the lease term, then it could be considered a financing lease.
Katie, you mentioned that the bright line tests have fallen away. Is there any definition or what do we see or what are we using for substantially all or majority? Is there anything out there? So
it's not specifically mentioned in the guidance, but what we as accountants all fall back on, we like the specific numbers and to get as far away from the gray area as possible. We still primarily use those bright line tests as a guide. And if it's near those numbers, then we could still consider it to be used for that.
Got it. Thanks. Michael, let's go back to you with this one. Are there any differences how one would measure lease cost for a finance lease versus an operating lease?
Yeah, and that's a great question. This is kind of where the rubber meets the road, right? So for finance lease costs, and you'll have to forgive me because we're kind of getting into details here, but just I'll try not to put too much gobbledygook out there. For finance lease costs, we're going to take, to measure the beginning lease liability, the present value of all the future payments. So that's what we're going to do to try to figure out the beginning lease liability for finance leases. And then the beginning asset balance is the asset's fair market value. Now, in theory, those two things should be the same. That's not always the case, but in theory, if you're leasing something and there's an interest rate implicit within the finance lease, the cross point of those two things should be the fair market value of the equipment you're renting. Because A, you wouldn't rent equipment for more than it's worth, and B, nobody would lease it out for less than it's worth. So they should cross at that point. And then when we talk about what we're going to do with the asset and the asset's going to be amortized or depreciated straight line, just how GAAP has always depreciated fixed assets, same as it's always been for capital leases. And the lease liability is amortized using the effective interest method. So for finance leases, we're going to have a portion of the expense will get allocated to the rent expense, and a portion will be allocated to interest expense. And I realized I just mentioned the effective interest method, and part 2 is where we talk about stumbling blocks and really kind of some debits and credits. So I'll leave that to part 2, the effective interest method. But really, that part is vitally important to both finance lease and operating leases. So that's all finance leases. So now if we switch over to operating leases, the beginning lease liability for operating leases is measured similarly. We're going to take the present value of the future cash payments, and the beginning asset balance will always match the liability for operating leases unless there are a few certain circumstances. Things like a tenant improvement allowance or direct lease costs that you might incur to get the lease operating and going. That could be something like having an attorney review the lease or something like that. But that's the only thing that would kind of throw off our difference for an operating lease, a difference between the lease liability and the right of use asset. So then when we think about winding these things down, the lease liability is going to wind down with the effective interest method. But this time for operating leases, we're not going to break it out between rent expense and interest expense on our income statement. It's going to run through our income statement as one line item, which would be rent expense. The amortization of the right of use asset is determined by, and I'm not kidding when I tell you this, the plug method. And this is laid out pretty clearly in.
That's a four-letter word, Michael.
I know, but it's written out very clearly, and the guidance even says something along the lines of, there is no other way to calculate this. It's literally what you need to balance the journal entry. So that will wind down the right of use asset. And this makes a lot more sense if you're partnered with either a software company who can do this kind of thing and you can kind of see it all in front of you, or if you have your friendly neighborhood CPA walk you through it with an amortization schedule. But anyway, that's bringing down the right of use asset as we go. And then the lease expense, for anybody who's into leases under the old guidance, we've always had straight line rent. Or at least that's what we call it. Kind of around here, the jargon we call it around here is, we should always be recognizing our rent, our lease expense straight line. So no matter if you have escalating rent that starts at $100 per month, and by the end of the lease, you're paying $10,000 per month, we're going to recognize that lease expense straight line over that entire period. So maybe it sounds a little complicated, but it's really not that complicated. We would take the undiscounted lease payments for every single month, add them all up, and divide them by the total months of the lease, and that will give us our straight line rent expense. And again, that's how we should have been recognizing it before, and we're still doing that now for operating leases.
Thanks, Michael. Certainly a lot to think about with the effect on your trial balance, right? Not just your balance sheet, but your P&L as well. With some of those changes, it sounds like we might have some issues or concerns with debt covenants, capital requirements. Katie, why don't you go ahead and explain to our listeners how the implementation of ASC 842 will affect a company's debt covenants and capital requirements?
Sure. And this is definitely something to keep on your radar as you would be going through this adoption. Hopefully, you've already had some conversations with your banker about this. And one of the most common debt covenants that companies will have is a certain required debt to equity ratio. And obviously, if we think about a balance sheet being your assets equals your liabilities plus your equity, if you're only taking your debt and your equity in the ratio and not including your assets and your debt's going up, then that's obviously going to cause an increase in this ratio. So be aware that if you have a significant amount of operating leases, that lease liability may jump this ratio up to previously not reachable levels or what you thought may be reachable for those covenants. And then for financial institutions, they are measured based on various capital levels. There is a ratio that would be impacted for financial institutions that have a significant amount of operating leases, and that would be the total capital as a percentage of risk-weighted assets. The new right-of-use asset is going to be risk-weighted at 100%, so that would cause a potential change to that ratio. And then always don't forget that if you need an audit or a reviewed financial statement to be presented to the bank within a certain time requirement, again, please don't wait to deal with this lease accounting change, because you don't want to delay the close of the books. You don't want to delay the audit or review from occurring so that you don't miss those deadlines.
Thanks, Katie. Listeners, that concludes part 1 of our podcast, Countdown to ASC 842 Readiness. Katie and Michael, thank you both for spending time with us today and sharing your expertise. I truly appreciate it. To our listeners, we hope we provided you with a broad overview of the key components of the new Lease Accounting Standards and laid the groundwork for your next action steps, implementation of the standard within your business. For additional details around ASC 842 implementation, please follow us and connect on part 2 of this podcast, Steps, Tools, and Common Stumbling Blocks for ASC 842 Implementation.